The community of impact lawyers is working to amplify the role of law and lawyers in the movement to create a more sustainable and equitable global economy. Lawyers in the GAIL community are committed to using the practice of law to have a positive impact on the people and the planet. And really, I mean, in terms of there can never be a more relevant time for the community to be brought together, not just to tackle issues and disruptions and the many crises that's facing the world today, but also to come up with solutions to help and make a positive impact towards the people, the communities which really need the help the most as well. So it's not just to tackle disruption, but also find solutions to come up with innovative ways to make a positive impact as well. We've got a couple of fantastic panels lined up for you today, great speakers, and hope you enjoy those panels today. We try to keep the sessions extremely relevant. You'll hear a number of themes emerging from those two panels, which I'll come up in a little more detail. But before I hand over to today's speakers, I wanted to let you know about some of the other events that's happening as part of this launch week for us as well. So on Wednesday, GAIL Asia Pacific explores being an impact lawyer advising B Corps and impact-driven companies. Following this, our midweek global panel on ESG disclosures and greenwashing on Wednesday at 9 a.m. UK time is not to be missed. I mean, it's such a key theme coming through, not just documentation, structured processes. So that's a really, really good one to attend for everyone. And then following this, there's a midweek global panel on ESG disclosure and greenwashing. And we then, at the end of the week, on Friday, 4th March, 2 p.m. UK time, we have a closing main stage event, which looks at the future of GAIL and presents a panel looking at capital markets, benefit corporations, and universal ownership and implications of the recent Freshfields report. I was speaking to a few people at the start of this, and they said, so what is GAIL about? And I think the response from our President Bill was like, it's what we choose to make it to be. And I think that will resonate with a lot of you. It's because we've got a real opportunity, not just to tackle some of the most severe issues, but also to take the institution and make it as topical and as relevant as possible as well. But you can view the full launch week by logging to GAIL. Thanks, Sarah, for flagging that up as well. You can go to the event agenda at the top of the page to build out your personal agenda and download your calendar reminders. But don't worry if you missed any of this, because there are recordings, and you can log back in, and it should all be uploaded. So you don't need to be worried if you're on the move. But I would recommend personally you log in tomorrow to view today's earlier main stage event, which was the official launch with words from our President Bill Clark and a keynote from Sir Ronnie Cohen, and a panel on the regulatory endgame for the just transition. Again, a very, very topical debate there. A couple of housekeeping rules for if you're watching online, put your questions in the Q&A, and we will share these with the panel. For those in the room, please just raise your hand during the Q&A session, and someone will magically appear with a mic. So it just leaves me to introduce the panels for today. And our first panel today will look at the topic structuring impact funds, innovative forms and incentives, moderated by Louise Ollier, who's a senior counsel at CDC. Our second panel discussion followed after that will be chaired by Sarah Dobson, who will tackle the inherent conflicts between commercial pressures and ESG business and human rights. However, before we dive into the panels, absolute pleasure and delighted to introduce our first speaker, Paddy Carter, Director of Development Impact, Research and Policy. Before joining CDC, Paddy wrote about foreign aid and development finance for the Center of Global Development and for ODI. He has a PhD in economics from Bristol University, where he was also a British Academy postdoctoral fellow. He also has a background as an equities analyst and a financial journalist. Paddy will open today's events and by sharing with us the impact approach developed at the CDC Group. I'm personally looking forward to hearing how the CDC has embedded impact at the heart of their investment process. It's a question which I'm sure many people are keen to hear about as well. So over to you, Paddy. Thanks a lot.
Thank you very much. It's a great pleasure to be here. As mentioned, I'm something like an in-house economist here, so I don't have a very good idea of what I'm about to say and how it fits onto how you all see the world, which is exciting. I'm going to talk about how we think about impact at CDC and how we manage impact in our investment decisions and our portfolio management, and then how we structure performance incentives inside CDC to incentivize impact. And I'm going to start by defining impact, which risks a little bit wasting your time by stating the obvious, but I think that risk is worth taking because, in my experience, the word impact can mean quite different things to different people, which results in people talking at cross purposes and the organization not quite knowing what it's supposed to be measuring. So at heart, impact is about making a difference, which is about a change that's measured in the comparison of what happens if you do something relative to what would have happened if you hadn't done it. So CDC is a development finance institution. We are funded from the government's official development assistance budget, which means that not only are the businesses that we invest in supposed to be making a positive difference, but we are required to be making a difference as an investor over and above what the market would be doing in our absence. So that's often called additionality. We exist to do things that private investors would not. That's our mission. But additionality is not something that can be observed and measured. I could spend all of my allotted time this evening talking about how we approach that problem, but let's set it aside and focus on the easier problem of how to measure the impact that businesses have on the world. So firms usually cannot report what impact they have on the world. They can tell you how many people they employ, at what wages, but they can't tell you what those people would have been doing under some alternative scenario. These questions are extremely hard to answer. Is a company that creates many low-paid jobs doing something good, raising demand for labor at the low end of the market, or are they doing something bad, exploiting workers? Sometimes dedicated researchers can tease out impact in that sense. Sometimes it might even be possible to do within the investment life cycle. We might be able to conduct some surveys during due diligence, which answer some of these questions, or maybe after investment, we can do evaluations. But in the main, the objects that we have in front of us as we are taking investment decisions are not of that nature. Rather, we are in the business of trying to gather what you might call impact relevant information that tells us something about where impact, in the sense of making a difference, is more or less likely to be present, where it is more or less likely to be larger or smaller, and what the risks are. And then with that information in our hands, we need some organizing principles to make sense of it all. So the Sustainable Development Goals serve as something of an organizing principle, but they are a mixture of means and ends, and they do not help investors manage trade-offs. They're useful, but impact investors need more than a list of global objectives. So CDC, we are founders of something called the Operating Principles for Impact Management. That defines 9 elements of good practice. So OPIM tells you what you should be doing, but it doesn't tell you how you should be doing it. What you should be doing is to start by defining your impact objectives and then build impact management systems around delivering them. So at CDC, I'm hoping you might have seen, we've recently announced our new 5-year strategy, and that has 3 strategic development impact objectives, making investments that are productive, sustainable, and inclusive, which means that we are prioritizing investments that are going to raise productivity across an economy so it can sustain a decent standard of living for all, investments that are going to transform the economy so that it is environmentally sustainable and adapted to the changing climate, and investments that share the benefits of higher productivity and sustainability with lower income and marginalized sections of society. So that is how we have chosen to define what high or low impact means. Even with the help of some reasonably clear objectives, impact is a bewilderingly complicated idea. It covers everything from protecting rare parrots to performing cataract operations. So one of the fundamental challenges of managing impact is to find a way of making the incommensurable commensurable. You might find some people claim to be able to put dollar values on impact. Without attempting to justify myself now, I would say in the main, don't believe it. I think we need other valuation tools. So at CDC, we use a set of parallel but connected tools for incorporating impact into our investment decisions and subsequent portfolio management. Some of these tools put numbers or ratings on impact to help us make comparisons across all the different things that we do, but others bring structure to the problem, but they still require subjective judgments to make sense of things and to make comparisons across investments. We use something called an impact framework, which essentially consists of a set of questions that we ask of every investment. So what is the nature of the impact? Who is benefiting from it? How deep is that impact? How will it come about? And what are the risks to that impact? And what contribution are we making towards it as an investor? So that framework brings structure to how we assess every investment from inception to exit. But in another sense, that's unstructured data, because the answers can be in whatever form is appropriate. And the only way we have of processing that information is through the subjective judgments of development specialists and investment committee members. So we also use a quantitative impact scoring tool to help us manage impact at the portfolio level. So this tool is about extracting some standardized information from the investments that we're going to make, and then using that information to rank investments according to how good they look against our three impact objectives. It's not trying to measure impact in the same way as a dollar valuation might. We don't claim that an investment with a score of 8 has twice the impact of an investment with a score of 4. It's not intended to be accurate enough to be sufficient for decision-making purposes, but it is intended to be right on average. So individual errors cancel out, so to speak, when it's aggregated across the portfolio. In addition to monitoring performance against our strategic objectives, this impact score is also there to set incentives for the deal teams. So when they go out and originate investment opportunities, it needs to send to do that effectively, it needs to send some clear signals, and it can't emerge from a black box at the end of the investment process. And because it's also used for staff remuneration, we must also minimize the need for subjective judgments. We want it to be amenable to external assurance, so we're not marking our own homework, so to speak. We use an annual dollar-weighted impact score as part of what determines staff bonuses. That's done on a company-wide basis. We don't pay bonuses based on individual or team impact performance. So this score is one of the ways in which we manage trade-offs that sometimes exist, such as the occasional conflict between the desire to cut carbon emissions and to promote local economic development. Our scoring system will penalize greenhouse gas emissions, but it will reward productivity and inclusivity. Sometimes the net result is a high score. Sometimes it's a low score, which means that the transaction might not go ahead. But the impact score is not our only tool for managing these tensions. We have exclusion lists. We won't invest in coal, for instance, because we think that the balance of costs and benefits there never comes out in favor of doing that. And we have strict rules about when we think gas power investments are and are not justified. And we have whole specialist teams on E&S and climate who work hard on transactions, not only to mitigate risks, but also to look for opportunities to improve things and raise impact. So I'm not sure how successful that was. That was a real gallop, trying to give you an overview of how we manage impact at CDC. There's much more to say, so if any of this interests you, please come and find me and I'll be happy to keep talking. Thank you very much. We do have some time for Q&A now. I don't know how, but if anybody's asking questions online, they're going to make their way to me. And I think we've got a mic coming. I saw one question there.
Thanks very much. Yeah, thank you for that. That was really interesting. I have 2 questions on impact, if I can take advantage of that. No one else has their hand up. Over what timeline do you measure impact? And does that fit into other plans to fit in with the fact that this is a quite important decade for dealing with climate change? And is impact assessed individually or also in comparison to other projects? So to use your example, would you turn down a second project to protect a certain species if that was already sort of in your portfolio?
So,
Paddy, can you repeat the question? We can hear it.
So
Okay.
I was gesticulating with the hand holding the mic. I'll do it the other way around.
So one question was to do with the time horizons over which we measure impact. And the second was, I think it was about whether once we've sort of got something in our portfolio, would it make it less likely that we do it again?
Yeah, and is there like an overall strategy?
So the timeline varies. I mean, obviously, if it's, let's say, a hydropower dam, you can't start measuring its output until it's built. So our system has to sort of predict metrics, and then we track performance against it, kind of according to whatever timeline is appropriate for that particular investment. But we do standardize. We try to look at a 4-year time horizon. For instance, our data shows us that on average, job growth post-investment hits 0 after year 3. So you kind of think on average, whatever jobs you're going to create, you would have created them by the end of the 3rd year. And we also have a sort of a regular updating schedule. So I think every 2 years we go back and we sort of recalculate the bits of this impact score that can be recalculated, and then the scores change, and that actually feeds back into staff remuneration as well. Or at least that's the plan. We haven't done it yet because we've only launched this system 2 months ago, but yeah, that's how it's supposed to work. Now, one of the things that this score can do is it can, I guess, tell us if our portfolio is starting to look like a bit disjointed or sort of overweight in certain areas. So I don't think we go as far as saying, well, we've already protected parrots in that investment, we're not going to do that again. But if it does look like we've got too much going in a certain direction, by kind of looking at the underlying constituents of this score, we will be able to observe that. And I think that will feed back into kind of where we try to originate and what decisions we take, although I think it's not formalized in any way. So that works. Any more? Yeah. I don't know where the mic is.
Thanks. This is Oliver Hunt from Bates Wells. I have a question about once you're into an investment and you're analysing its impact, if you find that the impact is actually greater than you expected, might you then pivot on a new investment where you'd accept a slightly lower impact because the other one has, in a sense, outperformed? So assessing it on a sort of dynamic portfolio basis rather than case by case.
First, we do have the ability to. So I mentioned we update these scores if they are overperforming. We have ways of noticing that. I don't think we would think, well, we're in a sense, if we find ourselves getting loads of high-scoring investments and we are trying to hit a portfolio average, that does give us room, in a sense, to make more low-scoring investments. But still, our objective is to maximize impact. So we wouldn't sort of be the only kind of reason we would contemplate doing a lower-scoring investment. Well, we have other objectives, including financial and maybe some sort of geographical desires that our shareholder might have. But normally, I would say no, we wouldn't think to ourselves, oh, we've done one over there, let's slip a few lower scoring ones through. It's not how we do it, typically. I know.
Afternoon, very interesting. My question concerns keeping up with science. So you said earlier that at the moment you don't invest in anything linked with coal.
Yeah.
Now, I'm not a scientist, but I suspect the technology around coal improves. While clean coal sounds a contradiction in terms, it might be you get to a point where the figures, the metrics around coal-related pollution radically different. Does your model allow, through expertise and the actual process, for those sorts of potential changes?
Well, I mean, at the moment, coal is on the exclusion list. So, I mean, should something dramatic enough happen to the technology of coal power generation, then I guess the first thing we would need to do is revisit the exclusion list. But once kind of things that are within policy, now I'm going to wish that my climate team colleagues were here because it gets a bit complicated. But I think that first of all, we look at carbon emissions or greenhouse gas emissions. So if it's in policy and the amount of emissions is changing, we would observe that, and that would change the scores. And then secondly, I think there's part of the scoring system which works off, I think, benchmarks and transition paths. So I think the climate team is looking at science-based sort of way, what does good look like if you're making plastics? So I think that the changing science comes in a sort of benchmarking sense as well, in the guts of the system. And there's one here. I don't know how much time I've got, so I'm going to keep pointing at people.
Yeah, we did one more, and then we go straight to.
Okay, great. Hi, so here we're on with the blue top.
Thank you. I'll make it quick. How do you account for the fact that certain types of impact might take longer than others? For example, it might be easier to see that there's jobs created, but if you're trying to, for example, increase diversity, you might need 10, 15 years to see something like that. So how do you account for that in the scoring, and how do you measure returns?
So a lot of the effects that private enterprises have on the economy are indirect, and as you say, they happen over the long run. And if your reference to diversity was also to leadership diversity, a lot of the people that are interested in diversity here are often talking about system change rather than just these sort of one-off things. So, I mean, I think the short answer is we try and take an evidence-based view on what sort of things are most likely to lead to these long-term changes. We reward those things. We can't really observe them. I mean, maybe years hence, we might be able to look back and see whether what we hope would happen did happen. So we have parts of the system where, to be blunt, we've gone through the economics literature and seen what things there is evidence of sort of long-term transformational change, and then we create a list of them and we reward investments that are doing those things. So we do try and think about long-term indirect effects, but it is sort of crowbarred into the system in quite a simple way.
Thanks, Paddy.
Okay, thank you very much, everybody.
Paddy, that was an interesting whistle-stop tour of our impact indicators and measurements. So we've been asked to talk about the way that impact funds are being structured and the use of innovative forms to accommodate different forms of capital risk profiles. So we thought we'd discuss our experiences in structuring funds for impact, current trends we're seeing, gaps, best practices in structuring performance incentives to achieve impact objectives. Just to introduce myself, I've been here at CDC, soon to be British International Investment, for over 6 years, working on other intermediated investments in our markets. Before that, I was in private practice for quite a while, working on alternative funds generally. Just to put it in context, CDC, as of the end of 2021, had 242 funds and 146 managers in our portfolio. So we've seen quite the variety of funds, from the fairly commercial but still being measured for impact, right down to funds which are trying to invest in fragile states and are really only backed by DFI and impact investors. I've been joined on this panel by Chris and Simon, and I'll let them introduce themselves now. Chris?
Oh, okay.
Gosh, on the spot. I'm Chris Garner. I'm Associate General Counsel at a fund called Sunfunder, which is a debt fund. We have approximately 176 million under management. We provide financing primarily to the solar sector, solar home systems, and also commercial and industrial and small off-grid and mini-grid systems. The hint there is in the name, Sunfunder. But we're actually looking at doing a lot more than that over the next 15 years, actually, because we're in the process of raising one of our new funds, which is going to be about $500 million fund. Prior to Sunfunder, I've had a whole career based around emerging markets, DFIs, and impact, and have worked in-house at FMO. I spent a short period of time here at CDC, filling in for Louise while she was on another secondment, and have also worked for a number of other impact investors, both on the funds and private equity side.
Hi, hello everyone. Simon Meldrum, I represent the Red Cross Red Crescent. I'm not a lawyer, and my background is debt capital markets, structured finance for a number of years. I then got involved in impact investing. Some of you might know Access Foundation. I was their initial growth fund manager, which was a £45 million fund doing social investment in the UK. And I then joined the Red Cross in 2018 to look at how do we use new ways of financing our work, alternative investment. And I think it was a fascinating conversation from Chris about impact. I come from the kind of and I think it's really important and really useful questions. And from what I could follow from the very detailed presentation, the important thing is to be asking the questions, right? So I live in a world of impact, whereas chances are if you're having impact, you're making impact, right? So things that we're kind of measuring, and we're very much a work in progress as an organization, right? Around impact. And I think the level of sophistication that CDC bring, we can only imagine and aspire to. So delighted to come and support GAIL and the foundation of GAIL. Thanks for the invitation.
Okay, thanks both of you. I'm sure you're a very knowledgeable audience, but I just think it's probably worth reiterating the issues that we're seeing. People talk about impact funds and impact investing increasingly. I mean, you see it almost every day. And you can see that people like M&G are buying up, they just bought up Responsibility. So you can see there's an increasing mainstream interest in impact funds. But there's a huge gap between the need for capital in developing markets, emerging markets, and the amount of capital that actually gets invested. So we were just going to talk about two of the points that we think are particularly pertinent here. One is, how do you structure a fund to mobilize capital and crowd in where it's needed? And secondly, how do you ensure the best outcomes for both the investors and the managers and ensure that the two are aligned? So I think maybe just leading off on the first one about how do we set up funds to get the capital where it's needed? And I think perhaps maybe Simon, you could start on that.
Sure. Yeah. So I mean, mobilizing capital, I think, is the fundamental issue, right? And I think what I'm excited to see about GAIL and the alliance is there's a huge education process that needs to happen, right? In both. From where I sit as a humanitarian actor with a background in finances, the demand is there, right? So if we look at to put some numbers in context, so humanitarian sector is about 30 billion a year only. Okay, it's massively underfunded, and that gap, despite the increase in humanitarian aid, is growing and will accelerate due to climate change and events that we can only begin to comprehend, developing in Ukraine and across Europe. So humanitarian gaps are funding, government, funding and traditional funding sources are reducing. And also then there's the fundamental question about, equitability of that and appropriateness of funding in these contexts, right? So if you're talking about mobilizing capital at scale to address global markets, you need to consider and develop structures and funds that are going to bring in private investment. That's just a reality. That's gravity, okay? There is no other source of capital. So then it's, where is private capital appropriate? Under what terms is it appropriate? And what do you need to do to incentivize it? And I think the other thing, as people talk about this, and certainly and that's partly, so that's the supply of capital. And I think one of the things, I work or the organization I represent works in an organization, we work in less developed countries, low income countries, fragile and violent contexts, right? So a lot of the solutions that people talk about in impact or development finance aren't appropriate for the kind of problems that we're trying to address and trying to solve. And I think we need to move on beyond very quickly in mobilizing private capital to start to have that as part of the context. So maybe I'll stop there before I rant too much and give Chris an opportunity.
I was actually going to ask you a question.
Yeah.
Sorry, going off script here. Do you find that the whole shift in the discussion around sustainability and impact that's happened over the last few years has helped to bolster your cause in raising private finance? Because you see a lot of societal change, lots of consumer demand for crowding into the impact or at least sustainable space. There's governmental change on reporting and what you can and cannot do, and maybe changes around fiduciary duties and understanding from the commercial players and the commercial investors. And then of course there's a number of guarantee funds that are popping up and other support structures. Has that had a big impact?
I think it hasn't had a big impact yet, but I do think, that we can see these trends accelerating, right? With the interest that people are doing, the creation of forums like this, the awareness within, the awareness with community, within investors that are doing this. I still think there's a long way to go. So, for example, 2 years ago, I was working on a structure around water and sanitation. We were looking with the fund, and it was kind of we were bringing in a development bank to act as a guarantor to do blended finance, and we had a commercial proposition to issue bonds on that. Right, they would have been probably Southern Gas and grade, and we went to a number of investment houses who got very excited, household names, who got very excited about the idea, thought it was viable. But actually, when they went in to look at their mandates, their formal, so, we have Larry Fink sitting at the top going, yeah, it's all good, let's do lots of this. You actually bring transactions. And what we discovered was you needed to go back to asset allocation, because although institutionally there was a strategy there, they couldn't find portfolios to sit in. And so that's an example. So it's there, but there's a long way to go. There's a huge education, I think, part, not just on the demand side and about the organizations I work, but also on the supply side, right? And organizations, and what does it take to get these done?
So maybe you needed, when you talk about the asset allocation, was it because this product wasn't going to be profitable enough? Did it need to be propped up more from underneath? Or was the upside too small? Or was it because they just couldn't understand what it was and where it would fit in their portfolio?
Yeah, they just couldn't understand what it was. It was designed. I come from so the word sustainable, we talk a lot about in the humanitarian sector about being sustainable. And, sustainable, if we use it in the green, I'm looking at a green picture behind me. If we talk about sustainable, we talk a lot about recycling. Well, and you apply that to capital, that's recycling of capital. So you've got to have the cost of capital. And the only way to get scale is to bring in, as I said, if scale is the problem you're trying to address, and that's not appropriate in every context, then you need to attract private capital. And to attract private capital, you need to do that on a sustainable basis. To do that, you need to cover the cost of capital. And then, how do you do that? How do you subsidize it? And, or guarantees to make a risk-adjusted return. So that worked. The issue was, it didn't fit within a portfolio, right?
Right. Okay.
Yeah. No, I have to say from my experience, certainly on the sell side, working for a fund manager, we often find the same experience.
Right.
And we're in a super popular area, which, you know, sort of solar off-grid power
Right.
now is one
Right,
of the big
of the
things.
moment.
But you know, it should be the sweet spot for most commercial institutions. But you know, depending on who you're talking to, it still takes a lot of
Yes.
work to fit it within their own portfolio.
Yes.
And to see the risk-adjusted returns. And this is, I think, this is one of the challenges. Certainly, the structuring funds, structuring any of these sorts of projects, blending, which becomes kind of, for an audience like this, is probably oh God, not blending again, blended finance. But it certainly certainly has its place.
For sure.
And perhaps that's an element that needs to be developed.
We certainly seem to see, from our perspective, I'm seeing more funds that are blended, or where there's a first loss, which is only for the benefit of commercial investors. Perhaps you have a sort of split portfolio, or only for the benefit of certain, jurisdictions, something like that. But it does seem to come back to the blending or guarantees. Also see quite a lot of guarantees. Another issue that kind of comes up on these on impact funds is around alignment and incentives. You want the manager to be incentivized to do a great job of creating impact as well as being commercially successful, and the two are not always opposites, but they're perhaps there's an intersection where they meet. I guess personally, I'm surprised how most funds that I see, in fact, almost all funds that I see in the market, still have a very traditional carry structure. How can we incentivize the manager to create that impact? Maybe Chris, you can take this one.
Gosh, I think this also fits with what you were just saying, Simon, is what fits with people's understanding of how let's say in this case private equity funds should operate.
Right.
And if you sort of deviate from the traditional 2 in 20 model, how does it fit? Our systems as a big international institution don't operate. We can't fit this into our investment criteria. But we
like to do something new and innovative, but in an old style.
That's right.
Yeah, as long as it's not too challenging, it looks familiar.
We get that. Yeah, innovation is all good, but I want it to fit in the same box. And you're like, well, it's going to be really hard to do things differently if we do it in the same way.
Paint it a different color, maybe. Don't go too risky. But I've certainly seen a number. Probably, I'd say this, for me, there's really four ways that carry structures. Or some funds try and develop a hybrid of the traditional carry structure. And the first one is the negative carry. And that basically ties the carry that the fund manager is receiving to the impact results over the whole life of the fund. So it's a portfolio view, works really well with European waterfalls. And there's a reduction of carry, really taking money off the table for fund managers who don't hit certain targets. The second one is what I call the positive impact carry, and that's basically doing the opposite. So it's saying, well, on a portfolio basis, if you hit certain KPIs on the impact, then we'll release more money to you, rather than the LPs clawing back money. It's sort of a release from escrow of cash to the investment team to then go for that. I think the more innovative stuff, perhaps coming out of the US market, more so than what I've seen in Europe, is the super carry. came up with that myself on the train this morning. Super carry. It's basically a split structure where the funds that I've seen have sort of split the carry structure. So it's sort of, your 20% carry is split 10% on commercial returns, 10% on impact target achievement. And tied to that, sometimes there's sort of a ratchet down of the hurdle rate so that fund managers can get into their carry and get the economic incentives a lot quicker if they're doing really well with the impact. The problem with all of this, though, I think, is it's all tied to the traditional model of money makes sense, money directs behavior. And I guess as human beings, that's often a struggle that we have, right? We all want to do something good. We always kind of want to make a bit of money on the side and live somewhere nice. So yeah, is the incentive structure really are these the right models? But I think outside of that, and economists probably have a lot more thoughts on these and more thought through than I do. But at its very basics, you can create a whole hybrid of these sorts of incentive structures. And in the US market, as I alluded to, you see more and more of these. They tend to be, again, more based on smaller funds. So perhaps funds that are sponsored by family offices or foundations that have a real impact objective in any event, and work very closely with fund managers to put into place the KPIs and so forth for impacts of specific projects. I think also in the US, you see a lot more deal by deal carry structures, and that I think probably works better because not every project that a fund will invest in will have both a commercial and an impact result or positive impact result. So dealing with it on a fund by fund or investment by investment basis, which the US is more familiar with, tends to make more sense. But the fourth, I kind of alluding to all this already. The fourth model is really this hybrid where it really tries to build in whatever makes sense for the investment objective at the time. And I think one of the more interesting ones that I've seen over the last year was actually one that was funded by a family office that had a very clear impact objective and tied the impact KPIs to releasing technical assistance facilities, releasing bonuses for the fund manager as it hit those objectives. But again, I think a lot of these types of funds that exist in the market right now tend to be smaller, certainly sub 150 million, a lot sub 1 million in terms of size. So they really rely on a relationship with a foundation or an impact oriented family office or other type of investor that'll work closely with them. That's really what I'm seeing.
Yeah, it's interesting you say that about the releasing the technical assistance if certain impact indicators are met, because I was just thinking as you were talking about the incentives and how it often comes back to carry, is that some of the funds that I've seen that have been tranched and have had blended finance have just not been as heavily reliant on carry and have been more weighted towards maybe a more institutional manager where people are being paid like a slightly higher carry, a slightly higher management fee, and there isn't this expectation of carry. So it's perhaps, slightly less entrepreneurial. Maybe the investments are debt, so there's less upside. But there's this like regular management fee that they can pay bonuses out of. We're also looking at the moment at a fund where the underlying investments will be in instruments that only pay out. Basically, the money will only come back to the fund if the impact indicators are met. So these are development impact bonds, and it's a fund of development impact bonds, which is pretty interesting. But I have to admit that at the fund level, I don't think the carry will be a particularly persuasive part of the manager's incentives. So
I think this goes to Chris's point. I mean, and I think this is, this is very, as the impact story, these aren't easy questions, right? And there's a lot of detail. And if it was easy, we would have solved it years ago. So we should be patient with ourselves, but we should definitely be a lot more ambitious, right? I mean, the questions are the important thing to ask. And I think, Chris's point, which he kind of, to highlight, ultimately are tying these incentives to economic things really what's going to move the needle. I mean, the kind of world that I live in, and we can get very clever about this, is 2.3 billion people, 6 billion people on the planet, 7 billion people, 2.3 don't have access to clean water. 800 million people practice open defecation. Okay. I mean, when I first heard that number, I really just couldn't get my head around 800 million people practicing open defecation. I don't think we really need to get into incentives to do the right thing that are tied to economics and how people are carrying, right? And I do think this is really important, and attracting in commercial capital is vital, but we also need to kind of recognize we can get overly nuanced in these discussions, right? And I think we need to ask the right questions, and we need to challenge it. And I guess besides that point, I think, it depends, right? This is the question that, there's not one size fits all. There's not one recipe. We need to try different approaches or combinations of different approaches, whether that's impact measurement or legal or incentive, or all part of the solution, right? Yeah. But we just need to be much more ambitious in how we go about approaching these things.
Yeah, and perhaps more flexibility in the system is what eventually needs to be.
Yeah. Do you want and be more generous? Do you want to create impact, or do you want to measure, the impact you've created, right?
Yeah. Yeah. And measurements are completely other separate topic.
Like we're sitting here like we're sitting here, and what we should be asking ourselves are, okay, financial inclusion, being able to measure everything up the wazoo, does that enable people to get greater access to finance? Okay, and finance to travel further and deeper across Africa, because I can measure what mothers and children in communities are doing. Am I empowering those people, or am I limiting access to money? Right, and that's a that doesn't mean we shouldn't measure it, but we need to be super careful about kind of doing that stuff, right?
So maybe that leads me on. I mean, I think I think there's a lot of lawyers in the room, and you're not a lawyer, and I think you're coming from
you
told me. So no, but you come from a slightly different angle because of the humanitarian thing. What can we do as a room full of impact-oriented lawyers? What can we do to bridge the gap? What can we do to help you and your organization, organizations like you, to kind of bridge the gap a little bit? What could?
Well, I think one, that you're in the room. That's great, right? And I think being open to these discussions, like, I mean, I represent maybe I shouldn't say I represent, they'd be horrified about this, but what I'm saying, but I think, like, we're one of the biggest humanitarian organizations and networks in the world, but actually we're super under-resourced, because one of the reasons is we're reporting to lots of governments who want to have all our metrics, and you're like, anyway, but we're super unresourced. So skills and capacity is much needed, not just by the Red Cross and an hour thing, but if anyone wants to come and talk to me, I'll be delighted with that. But, generally within the organization, right? So I think really trying to, provide your skills and your resources as you are doing and lean into that, I think is tremendous. I think and asking these questions, there aren't any easy answers, right? Is I think something both collectively as an organization, but also individually in how you go about your work, right? I think be aware there's lots of stuff you can be doing, right?
Okay.
Trustee roles and things like that in all sorts of organizations, where rigor and that legal mindset can be incredibly valuable.
Great. Thank you so much. Shall I open the floor now to questions? Anyone in the room? Oh, so many already. Just let Joe catch you with the microphone. There's a lady here and a gentleman over there.
Thanks. So there's been a lot of discussion about the need to incentivize managers to be impactful in their investments. Do you not think there's more of a need to incentivize private investors to put money to work in impact investments? Because in our experience, we find that for making impact investments, obviously the DFIs are all there, but it's still very hard to tap into the private investors. And there's a lot of talk about them wanting to make impact investments, but unless the financial returns are still there, they just walk away from the table. So I don't know. I mean, there may not be an answer to this, but have you any thoughts as to how we go about incentivizing more private investments so that it's not just the club of DFIs there that are making these type of investments?
So, even though I'm moderator, I will jump in with that. I totally see this. I've had managers say to me, managers of large funds investing in Africa, it's really difficult for us because no one wants to invest in Africa if it doesn't produce the same financial returns as developed markets. We did talk a bit, I think, about the guarantees we see. Either governmental DFI foundations provide guarantees, sometimes only for commercial capital. When we're committing to funds, sometimes we'll, increase our commitment if it can be matched by private capital, sort of increased amount. Blended finance, so foundations or DFIs or governmental organizations providing first loss or mezzanine tranche to try and boost up the financial returns at the top end of the private sector. But I'm not sure if anyone else has any other ideas. After that, I get stuck.
Yeah, I mean, no, there's no secret sauce, right? Certainly I haven't found it, and it is very difficult. I also kind of think that, to the point about sustainable and cost of capital, okay, the value for money argument and all of that needs to be worked. But actually, if you're not paying the cost of capital, okay, what is the cost of capital and the risk-adjusted return that's appropriate? Big question. But if you're not paying that, then it's not a sustainable solution, right? So you can talk about sustainable, or and that doesn't mean everything has to be, because I do think there's a lot of these kinds of tools in impact are only ever going to be relevant to a minority of what we do because of the environment we want to work in, right? And we're so that's one context, right? And I do think, but if you're looking at scale, which is often our challenge, then you've got to be looking at private capital. And until externalities are started to be accounted for, right? Or you start to create something like, green bonds, or I think what we should be aspiring to and setting our ambition, right? And what I like to remind people is green bonds now, multi-billion-dollar market, blah, 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 blah. Everybody will know that much better than I. That only started in 2007. That's only 15 years ago, right? And I remember, EBRD or EIB, depending which house you're in, they'll have a little, fight about that. It was 150 million. And everyone went, that's kind of crazy. That's never going to happen. And now look. So, I think it goes to, but that's a piece of the puzzle that will happen outside this room, those kind of externalities, or when economists get involved and they start to account for that. And so in today's environment, I think it's, you won't get a subsidized return, or if you have to get a subsidized return, and I don't think there's too many other solutions beyond what you were saying, is then, then it's okay, how do we get to the cost of capital to get that in? I don't know if you have
Yeah,
a different view.
well, I have to be careful what I say because we're fundraising. And this is being recorded. So,
It's way too expensive.
yeah, I think the key, what we found is, as a key is having a blended finance structure makes sense for commercial investors who are coming in at the top, right? At the senior tranche. So you're basically de-risking a lot of their investment by having a first loss, by having a guarantee, by having someone sitting at MES level. That's really the key for being able to crowd in the commercial funders. I think they're all being pushed this way. Certainly in the climate finance front, there's no end of choice of institutions that want to push their money into this now, because they're being told by their consumers, by their clients, by governments, and so forth that this is the thing. But it is still incredibly difficult because in order to blend a structure, you need people who are going to come in at those other levels, and there's not that many of those institutions at those levels. Certainly not on any large scale. And I think this is why, probably a lot of the private equity funds that I mentioned before that have more novel structures are very small and very sort of focused on a particular segment of the market. But to do anything bigger, it is challenging. And I think, yes, there's a conversation, but I've been working in this sector for quite a while, since about 2006, I think, when I first started working with DFIs. And I think the conversation is changing. I think we're on the right, the trajectory is correct. When I first started working on DFI related emerging market work, I had lots of colleagues turning around to me and, as well as friends going, is that charity? Is that, does that actually make sense? Are you just throwing your money away? And now it's like mainstream conversations. So the conversations are happening. And I think this is where it goes into your point earlier, Simon, that having these sorts of conversations within a group like this make a lot of sense, because we're pushing things forwards. We have the ability to change the conversation, and hopefully take that back to those big funders that will eventually change their systems. But it's a tough one.
Patience, yeah. I think there was a question right over there. I know there were some more questions that went up.
There's a
I think
question
the gentleman
online,
over
is
there.
there?
I was there.
We also have one from online, if you all don't mind. It was something Chris was discussing earlier. How do you structure deal by deal, and what entity is set up with each investment?
Gosh. Someone's putting me on the spot. Basically, what I was suggesting is that the carried interest that the fund manager will be receiving is based on the exit from a particular investment, rather than on a portfolio level. So if you're focusing it on particular investments, particular projects, then it can be easier to assess what the impact has been on that project, as well as what the commercial returns are, and allocate the funds accordingly. So that's why you see a lot of these deals, or a lot of these structures being done in US funds and US focused funds that tend to deal with more sort of particular, deal by deal rather than portfolio level assessments of carry and distributions. And in terms of particular structures, yeah, I've not seen any particular structures other than ones out there in the market. So.
It's normally just a regular fund, but it's a different way of structuring the waterfall so that you look at the returns from one investment rather than all of them. So I'm conscious of time. How do we have time for a couple more questions? One more question. Okay.
Okay, great. I'll try and keep it brief. I just what Simon said really resonated with me. I until quite recently worked for EY. Can you hear that? Yeah. Okay. Worked for. Oh, okay. Yeah, I worked for EY until quite recently, so we're all about metrics and frameworks. But I do think there's a danger that there's too much of an emphasis on that rather than the actual impact. My question was going to be, I guess, in the sort of what are the longer term options for funding for social impact, where I guess impact is as important as the financial return. Looking at, I don't know if people could talk about where social impact bonds, that kind of thing, are going. That'd be great.
Yeah, I mean, social impact bonds, I think, have very specific and dedicated outcomes where there's a really very measurable return and metrics. But in the world that I'm kind of looking at or asked to address, it comes down to, in 10 years, there's been 480 million of impact bonds. The vast, I think 16 in developed or lower income countries. So it's really not, unless we're looking for a particular application, a particular situation, something that I'm generally focused on, right? But I think longer term, yeah, I mean, I think until externalities start getting measured, right, I don't see how this kind of gets to scale. And I think it's really about, asking the questions. I mean, I think the presentation ahead of us was really, informative. I mean, about just how complicated and difficult this is. And at the end of the day, can you get caught up and lose sight of that as opposed to, what are we trying to do, right? And how do we do that? I think I should stop before we run out of time.
I think we're out of time, but thank you again for joining me to talk about your experiences and these things. And we'll pass over to the next panel. Thank you.
Hello, and welcome to this section of the event. We've had some really great panels so far and a presentation from Paddy. So I wanted to say thank you for that to start with. I'm Sarah Dodson. I'm Executive Director of the Global Alliance of Impact Lawyers, and I'm standing in today for Naomi Sander, who has unfortunately tested positive for COVID, but thanks to her wonderful preparation, we have a really interesting panel for us today. So thank you to her for putting this together. The panel today is on ESG, business and human rights, and commercial pressures. And we're looking at tackling some of the inherent conflicts within that. So looking at the intersectionality and interrelated nature of environmental, social, and governance factors, and the need to tackle conflicts such as the human rights responsibilities of businesses as weighed against commercial pressures. So looking a bit at identifying opportunities and attempting to ensure that new sustainable solutions don't then create unintended adverse consequences for other pillars of ESG. So we've got a few minutes together today. I'm hoping that we're going to begin to cover some of the legal opportunities, realities, and complexities of implementing an impact approach in the face of these challenges. So what does the meat of this topic mean? Well, we know that making impactful commercial, financial, or investment decisions that respect human rights and ESG can, of course, be challenging, and particularly when conflicting interests arise. Sometimes it's not just a question of doing the right thing, and what the right thing is can be hard to unpick. So some of the conflicts we're going to look at today are those arising in meetings and boardrooms across the impact community. And there's a few questions that I'll start out with before we hear from our speakers. Firstly, do we need to choose between the best commercial decision and the decision that leads to the best positive? Do we need to choose between the best commercial decision and the decision that leads to the best positive impact? Secondly, how do we address conflicts within impact outcomes where a positive impact in one area might lead to a negative impact in another? And of course, we touched on this a bit in previous panel discussions, and it's a relevant consideration. And thirdly, how can we create systems and processes to identify the opportunities arising from ESG stacking? There's a lot in there. What I'm hoping we'll definitely get to, even if we don't cover all of those in detail, is specifically what's the role of lawyers in supporting their clients and developing their ecosystem in this respect. So a lot to discuss. I'd now like to introduce our speakers. We're joined by Olivia Wyndham-Stewart, a specialist in business and human rights and labour issues, focusing on commercial decision-making and human rights in manufacturing and sector and in ethical fashion. Olivia is a senior fellow and deputy director of the Business and Human Rights Law Programme at Rutgers, New Jersey.
Yeah, I'm half New Jersey, half UK.
Wonderful. Rutgers Law School's Centre for Corporate Law and Governance. And our second speaker is Ranajoy Basu, who is a finance lawyer at Hogan Lovells in London, where she established and leads the Hogan Lovells Global Sustainable Finance and Investment Group, and regularly works with clients on ESG, sustainability, and impact initiatives. On that point, I'm going to pass first to Olivia with a question. Can you tell us a bit about some of the tensions that exist in your experience between a company's human rights commitments and its commercial and contracting practices? So thinking here, how might traditional approaches to sourcing and contracting create risks in the S of ESG rather than upholding them?
Yes, absolutely. Thank you very much for having me. First of all, it's lovely to be here. It's very, very interesting. I'm not a lawyer, again, so we have another one, a non-lawyer in the room. And I also have to confess, I don't work a lot in investing or impact investing. I work in supply chains. So I spend my time in supply chains, thinking about how human rights in supply chains can be upheld or are being infringed upon or at risk. So traditionally, before COVID, that meant spending a lot of time not in the UK or certainly outside of London. And in the course of that work, I came to it, of course, from the perspective of human rights, but I have increasingly moved towards commercial relationships and the impact that commercial relationships can have on human rights. Because we have a very well-formed structure, understanding of what human rights are. We have the Universal Declaration of Human Rights. We have the ILO fundamentals. We understand, even if we can't really always uphold, what human rights are and what they look like. What we really don't have in supply chains, in some, especially in manufacturing, is a very good idea of what good commercial practices and good commercial relationships that uphold human rights might look like. So it's possible for companies to kind of leapfrog their responsible duties by treating their business relationships in a very abusive manner. So by having very, very aggressive or punitive or extractive relationships with their business partners, this is extremely common in supply chains. You will have a company that has an ethical team who has a very lovely policy and a very nice list of all the things they really don't want to see or do want to see in their supply chain. And you will have a buying team that's probably not really allowed to talk to the ethical team and certainly doesn't really want to get involved very much, who is kind of pursuing a slightly different agenda, which is, of course, to get the goods for the best possible price. I mean, this is in public procurement also. You have the best, the most economical, whatever. So the legal teams and the procurement teams are working over here, and the ethical team is working over here. And before the contract is signed, the ethical team will put a nice clause in that says, and by the way, we really like human rights. So if you could please do your best to uphold human rights and make sure that we have the best possible, circumstances for all of our workers, we'd really appreciate it. but I'm not going to pay you the cost of production for the goods because I don't have to. And if I cause you a delay, I'm going to penalize you for it because I can and it's in the contract. And I might change the order, or I might pull the order, and I'm not going to pay you because I don't have to. Even if you've produced the goods, I don't have to. And it happened, there was a very, very extreme case of this during COVID, where many international companies that we know well completely cancelled their orders, left goods in factories, even if they've been delivered, said we're not going to pay for them because we can't sell them. Workers were laid off. There was very widespread hunger. There was people going back to their villages. They had not been paid for the works that had been produced. And this is all allowed legally because this is what the contract says. It's completely permitted. And the company has managed the risk by inserting the clause that says, but we really respect human rights. It's just we have a contract that doesn't allow us to uphold it. So I've had so many suppliers over the years coming to me and saying, like, you know, pulling me aside and showing me their contract, and I don't know what to do about it, and we don't have the legal knowledge or any. So anyway, it's very difficult to work in supply chains and overcome these tensions because there's nothing to help suppliers do this because we don't see them as relevant actors in the ecosystem. So the reason I'm here as a non-lawyer is because I have been working very closely with a group of lawyers from the American Bar Association Business Law section to see how we can revise contracting practices so as to better uphold human rights in supply chains. Because I fundamentally believe that the most important element of human rights is commercial. It's about the relationship between the businesses. It's about how much workers ultimately get paid. It's about how much money is actually going down the supply chain. We like to think a lot about how much money can be brought up the supply chain or be created by the supply chain, but it's really about how much money you need to send down the supply chain. And if you want to do that, you have to have a good contract that is not designed to extract money at every possible opportunity. Otherwise, you will obviously get you. If I do not pay you enough, I will obviously have a human rights problem. But we like to think that there's some magical land where this doesn't exist and everyone is like happy, even though nobody's paying for anyone to be happy. So anyway, so that's why I'm here. And those are some of the tensions that exist and have not gone away in all the years that I'm working. It's like, you know, beating down the same door. They don't go away because we don't have the tools legally to overcome them, or commercially, or anything else. So anyway, so there you go. That's some of my thoughts about that.
And thank you for sharing that. And I know we'll dig in some more to exactly what's behind the model contract clauses work and where you see that going and how that might be relevant for lawyers in the room and watching online. But I'll just go to Sukvir first with a question for you. Question on prioritising impact. So even after a decision is made to prioritise impact, even if it's irrespective of any cost consequences, there are still difficult decisions to be made. So an example could be the potential conflicting thoughts of an investor looking at a proposal to finance a new coal plant in a country with severe energy poverty. Is there an inherent conflict between the E and the S of the ESG here? And if so, how does an investor decide?
I'll come on to that sort of question, just if I can just go to some of what Olivia's just said, but also the panel before us as well. So we just contextualise the practice, I guess, because it does address some of your points, Olivia. So we decided to formalise our sustainable finance investment practice back in 2019 because we identified that, you know, this siloed approach that you sort of have just referenced, where there is perhaps a sustainability policy which goes into the bottom drawer and never sees the light of day, or there's groups of knowledge and concentrated knowledge and awareness within an organisation, but it doesn't filter through, and there's a need for education and awareness so that actually it could be real impact. And so what we decided to do was sort of consolidate our practice so that we were delivering advice in a sort of seamless fashion. and making sure that we were advising our clients across the sort of ESG areas, and really able to identify the conflicts, but also inherent opportunities and low-hanging fruit sometimes in the context of sustainable finance and investment. And then when clients are looking at creating solutions, making sure that they're identifying what the unintended consequences of those possible solutions can be, and so that we're not actually just sort of creating problems going forward. And so with that in mind, we're focusing on three things, one of which we were discussing before just as we got here. The first is sort of, advice in the way that we're advising. So it's not sufficient anymore for lawyers to sort of advise specifically just on that question that your clients are sort of addressing. If they're coming to us and sort of saying, how do we select key performance indicators, or how do we select set sustainability performance targets? If we just respond to that specific question, we're not advising well enough. It is absolutely crucial that we do that within the sort of wider ESG landscape, so that we're identifying the risks that they possibly could come across, but also the opportunities. Don't just select that KPI because it's low-hanging fruit for you or it's the easier one. What else is there? Do you understand the interrelatedness of E, S, and G? Have you understood, if you're looking at green finance, what the social elements of that could be? And have you taken all of this into account? So that's one of the aspects, but the other is product creation. And there's a real focus here on processes and systems as well. So to take your example, to make sure that actually the client's not just operating in siloed fashion, you're focusing on supply chains. What does that mean, and how are you integrating it? And as lawyers with sort of varied practices, we speak the language of lots of different teams. And we can therefore be that bridge between ESG teams, for example, and finance teams and deal teams, and create frameworks which translate, law and regulation, soft law frameworks, the guidance that industry bodies have created. And going to one of the earlier points of the earlier panel, how do we take that information and help and enable our clients? What's the how there? So it's all very well to sort of say, you've got to sort of take into account SFDR, for example, and do no significant harm in the context of a fund. How do you select those? How do you actually measure that? What are the key E and S indicators for your particular organization? And how do you make sure that's implemented throughout your organization? So it's not just one team, but you've tracked it all the way through. So that's just a sort of an overview on that. So just coming to your question, Sarah, which I haven't actually got to. Sorry, but the first thing is, we can perceive there to be a tension between the E and the S and costs, for example. But actually, isn't this? Let's just step back from this. What does this mean for business? Yes, business is evolving, and we've got to respond to the changing landscape. But businesses have to do that all the time. This is not another change that's required. So yes, there's a tension between change, because there's changes required, whether that's, implementing new frameworks, or whether it's a collection of data, or it's disclosure and reporting. There are cost implications to all of this. But that doesn't mean there's necessarily going to be a hit on your bottom line in the medium and short term. In fact, research is showing us that that's not the case. If you take a medium and a long-term view, you're more likely to be embracing your external stakeholders and creating a more viable business going forward. But let's take your example of a coal power plant. If that is the only way, has that business considered what pressure external stakeholders may bring? Is that the right energy project for that particular country? And if it is, how are they going to transition to a cleaner source of energy? And when and if they do, they've got to, what are their plans for local capacity building? And how are they going to bring together sort of, the local communities and the region? And here it's really important to look at a just transition. And again, I come back to my point of, when we're creating solutions, let's also look at the consequences of those solutions. And we have to think about this when we're looking at net zero generally. You know, we're transitioning to net zero, but we've got to make sure that's a just transition. And that's, you know, closer to home as well when we look at levelling up and we're bringing in digital solutions. Who are we going to harm through those digital solutions, and how are we going to make sure that we are creating, you know, frameworks and opportunities for those people? So I'll stop there, otherwise I'll keep going. But yeah, sorry.
No, thank you for that. And I think that point about sort of looking at opportunities holistically and advising clients beyond the scope of the specific instruction that you've been given is something that we hear again and again within GAIL and within the community of lawyers reflecting on their role as legal, but also at moments strategic advisor, drawing on the knowledge that they have of working across those different spaces, as you pointed out. I thought I might go back to Olivia's point and just ask for you to dig in a little bit more into the model contract clauses project and where you see that going, perhaps in the context of where you see regulation heading and how companies and businesses ought to be responding to this. And then we might move on to looking at the implications for their legal team and advisors.
Yeah, absolutely. But also just to reflect now on your points, just two things came to mind. Absolutely the importance of communication and like making sure you are really breaking down the silos between the departments. I mean, I think one of the quickest ways I like to kind of suss out how serious business is like who is reporting to whom and who is allowed to speak to whom and when. And if certain people are reporting to the wrong sorts of people, or, I mean, they're fine in and of themselves, these people, but perhaps not the people who are best to be talking to about this particular issue, I genuinely consider it to be a human rights risk. Like who is talking to whom in an organization is a salient risk for me in terms of how things are then being implemented in the supply chain in particular. The other thing is about the unintended consequences that in manufacturing, there are a lot of cases of people working really hard to make a product have a lighter environmental impact. And then, of course, the product sells like hotcakes and the overall environmental impact is 50 times worse because the product is so in demand that it's had a less good impact than if they'd never done it in the first place. So also like how to factor in like growth and at what level are you looking at impact, because there is a lot of product level impact, but we need to look at this in a very large way to really understand kind of what's going on. Anyway, back to the contracts. So yes, okay. The work that we've done on the contracts is really to it's a kind of targeted intervention that we think is useful to supply chains, because as I have described, the way contracts have traditionally worked is to sort of sign off risk and hand the responsibilities for human rights to the supplier and just let it be known that that's what you would like, and then do whatever you like when it comes to the commercial and business relationships. So in that sense, the contract will usually ask the supplier to represent and warrant X, Y, and Z. And we have tried to completely do away with that form of contracting in favor of a human rights due diligence approach to contracting. So I don't know how familiar the room is with the principles of human rights due diligence. It's really enshrined in the United Nations guiding principles and in the OECD guidance for responsible business conduct. So these are the kind of international instruments that we have that we think should guide business conduct. And the principles of that are very much centered on the idea of shared responsibility. So if there are human rights risks in the supply chain, the responsibility is that of the buyer and the supplier. It is not simply the responsibility of the supplier to manage this, come what may, whatever I do as the buyer. I, the buyer, am taking on some of that risk. So I commit with you to engage in a process of human rights due diligence whereby we both have to manage this. And in that sense, I make certain commitments to you as a supplier. I will engage in processes that will ensure that I am providing reasonable remuneration for the products. There will be reasonable costing. I will take responsibility for change orders and modifications. Like, I will do my bit. And if there is a breach of contract, if there is a breach of the human rights commitments and standards that we have, we're not going to have a traditional regime of remedies between parties. We're going to focus on human rights remediation first. So we are going to put the adverse impacts and remediating those adverse impacts at the center of our commitments and our approach to working together. So in that sense, it's a bit of a kind of overhaul in how contracting, and particularly contracting for human rights, works when it comes to manufacturing and the procurement of goods in your supply chain. These were published. This is all with a working group of the business law section of the American Bar Association, which is interesting because these are business lawyers thinking about how to advise companies to engage in the procurement of goods. It's published on the American Bar Association Center for Human Rights website. So we're really working now at the intersection of the business community and the human rights community. And we think that those sorts of conversations and collaborations are quite essential to actually progressing some of this work. So these were published earlier last year, and now we're working with companies and larger sort of groups of companies and manufacturers to look at how we actually implement these in practice, and the impacts that would then have on the human rights outcomes and standards in the supply chain as we go forward.
Can I just
Sorry.
I just want to come back on your point at the very outset that you made there about sort of, you create sort of a light green product and then it sort of sells out and it's the end result is no longer as good. I mean, and this also ties in with the just transition and how we make sure it's very inclusive, because one of the problems is around SME financing, because the way that law and regulation is currently working it seems to be working against SMEs being able to access finance, because regulation isn't really taking into account how SMEs are conducting their businesses. So if we look at taxonomies, the sort of the taxonomy coming out of the EU doesn't take into account the way that SMEs classify their sort of activities. So what that means is that banks and intermediaries who are sort of the first source of capital have either the option of sort of laboriously matching the taxonomy if they want to, or being able to classify it in some way, or actually it becomes something that they don't have the data for. And then, the risk of sustainability washing and the need to sort of take a very tight approach means that, again, frameworks and guidance are being developed, so they're much tighter. And they require, for example, the existence of a sustainability policy, of some kind of historical data, all of which is contributing to sort of SMEs being sort of crowded out of the market, which means that there's then an even bigger perception issue when it comes to clean tech and clean businesses who are actually perceived as being riskier. So where do they go for that? And one of the places that they are looking to go is blended capital structures. But then that really needs people to understand what the needs are and the data. But again, there can't be too much focus on measurement and metrics, otherwise these organizations are never going to get any finance. So what do we do about that? And then your point around toolkits, I mean, this also goes to sort of collaborations and partnerships, because we just need to make this all a lot easier. And where there's a lot of information around environmental and science, for example, there's less around human rights, there's less around diversity and inclusion, and JEDI, justice, equity, diversity and inclusion. And that's where sort of there are increasing, sort of, I know CDC has a lot of information on this, and there's 2X Collaborative and Gender Smart, and that's sort of additional sources of information.
That's really helpful, and also taps into my next question for you. So that's been partially covered. I was going to ask you about the tools that are available to help companies, and you've touched on some of those already in terms of the Gender Lens toolkit. I wonder if I might just, and I'm mindful of time, so we'll open it out for questions from the audience in just a moment. But do you think what do you think lawyers can practically be doing to assist their clients in managing conflict and adverse harm? And how do you think businesses should be preparing for the shifts that may be coming in terms of regulation? So the first part for Sapphire and the second for Olivia.
So I think that how can lawyers help? I think this goes back to one of the points from the previous panel. And I really can't emphasize this enough, but raising awareness and having education and training programs where we are demystifying the complexity around this. And really sort of making sure that we're identifying the opportunities daily in the context of our advice around ESG, how they interrelate, the intersectionality, the opportunities and the risks, but also sort of how clients can really look at this in a different way. And that means just bringing it into our everyday through the education and training programs that we have, but also in the advice that we're giving. And the other point is product creation. So taking the regulation, taking the sort of guidance, taking sort of what's coming out of trade associations and translating it into usable toolkits. So again, there's a real sort of action point here. We can bog ourselves down in a lot of detail. And as a lawyer, it's incredible that I'm saying this, but let's get the balance right between sort of the need for absolute certainty and the need to take action and sort of have practical action.
Great. And I mean, I think on both of those points, how can lawyers and how can companies kind of prepare themselves for regulation? I mean, companies need to know their risks. I think with the regulation that's coming, with the regulatory environment that's changing, it's not a particularly smart strategy to try and offload your risks and just write good policies. You really, really need to get to know your supply chain, and it's really not rocket science. You need to know where your goods are coming from. You need to understand what your most salient risks are, and then you need to start addressing them quickly, because soon it's going to be riskier to just sign those off in a nice policy and try and ask your suppliers to take care of them than it is to understand them and get ahead of them. So I think the risk landscape is changing quite significantly, I would hope, so that companies will start being much more proactive. I mean, it's going to take a little while for some of this legislation to come in, and it's yet not entirely clear like how it will impact on some companies, but I'm quite hopeful that companies' attitudes will change more quickly than they have done historically.
Let's hope. On that point, I'll open it out to questions from the floor. There's one just over there.
Thanks very much. That was really interesting. My question is regarding regulation coming in and the Commission's adoption of the Corporate Sustainability Due Diligence Directive. I was just kind of interested to hear your thoughts on its scope and also how that interrelates with soft law instruments, and whether you think we need more hard law instruments coming in, or if it's just a mindset shift that you need corporates to kind of acknowledge and accept the soft law instruments slightly more.
Great, thanks. So the EU has published their proposal for the due diligence legislation just on Wednesday. Many people are disappointed by the scope of that because they were hoping that it would sort of catch many more companies. It's a political question, really. Like, I'm all for catching all the companies. Other people are up for catching fewer of the companies and like hoping for the mindset shift. I'm skeptical about the mindset shift. I take a pro-regulation stance on basically all of it. I appreciate the alignment with the due diligence, with the UNGPs, with the OECD guidance. If I want to talk specifically about contracts in that legislation, because the proposal does mention contracts and says you must sort of, it obliges the Commission to produce guidance on model contract clauses, which we've done. However, it's actually asking them for something I consider to be a bit regressive, which is just assurances from your suppliers. So it has a whole due diligence framework which says engage in due diligence, work with your suppliers, understand your key risks, but just seek an assurance in your contract that there's no human rights abuses. So a lot of work needs to be done on that. And there's a whole process now where people will be looking at the legislation and obviously offering their kind of feedback and responses on that. So I would like the scope to be bigger. I'm very sort of pro more regulation, and I'd like the contract stuff to be much more aligned with the actual due diligence approach rather than the reps one that they have before.
I might just disagree a little bit.
Absolutely.
I mean, it's not perfect, but the fact is that it was prior to this, it's been sort of left sort of voluntary. Companies do what they can and how they can. The problem with that approach is that quite often it's companies take the first step, but environmental and social harm actually occurs much later in supply chains. This is what it's a really important step at going further. And the other thing is that, whilst things might not be perfect because, there's constant shifting landscape and there's like additional information coming out all the time, actually, once that process starts, it means that, organizations must start thinking about it. And that in itself is a really important step. If we look at sort of things like the trade association guidance and principles around sort of green bonds and sustainability linked loans, for example, just the very fact that those have gone down in writing and there are principles and there is guidance has seen the volumes of those financial products, rise. And so there is, I believe that there is a mindset shift, and it's like everybody's responsibility to sort of build on that.
I agree. I don't disagree with that. There is a mindset shift. I just really like it if it's backed up by regulation.
One more.
Yeah. Can I please sorry.
I can hear you.
Go ahead.
Nobody's mentioned the Modern Slavery Act.
Right.
That's not bad. I mean, the whole disclosure generally, I guess.
Yeah, I mean,
that hasn't helped at all.
I have some negative comments about that. Do you have any? Or do you want some positive ones?
You go.
That did encourage a mindset shift, but I think the impact has been limited because it's a disclosure and there are very few penalties. It doesn't have any penalties attached to it. Many companies don't even report. So, I mean, I've geeked out on Modern Slavery Acts, but I don't know if many people do. There are many, many companies. I think tens of thousands of companies that haven't done it. And they haven't even had a central registry where they can check who's doing it and who's not doing it. Some people do spend time writing really good, interesting Modern Slavery Acts that show that they are really grappling with the issues. It's very unreliable between sectors. It's very uneven. Some sectors do it more than others. Some sectors, it's clearly a trend not to really do it at all. It's had very limited impact on the ground, I would think. It's kept a lot of consultants in work.
From a finance perspective, I've always seen, sort of depending on the organisation and the applicability of it, it's always included in due diligence. So it's an integral part of the investment process. I mean, that doesn't mean that, to what extent is the information being collected and is being monitored, but it's part of the investment process. I've always seen that.
Yeah, I mean, it does. It functions in the ecosystem, but the impact it's actually having on forced labour in the real world, I don't know. I mean, people are much more aware of forced labour than they used to be, and that's a good start. But I'd like to see something a bit more serious when it actually comes to really addressing forced labour.
I think purely because of time, we're going to wrap things up there, but I want to end on a positive note if we can. So I'm going to ask you for one thing that you see happening, which causes you to hope that that mindset shift is happening at a speed that you might feel comfortable with, and that we are succeeding in changing the conversation.
You go after you.
I think particularly sort of last quarter of last year and the whole of this year, what we're seeing is our clients sort of certainly saying, this is what we need to do, this is what we're obliged to do, but we want to go further. How can you help us to go further? So there is now sort of not the what must we do, it's what more can we do? We want to be leaders in this, and that's very reassuring.
Yeah, I think that's completely right. I mean, I think that when I think back, sometimes I feel like, oh, there's never any progress. But when I think back to the conversations in this industry when I started, and now it's not even that weird to be a business and human rights specialist. Like 10 years ago, nobody even really knew what that meant. But it's really changing, and that's becoming like a field of expertise that works with lawyers, that works with policymakers. It's a completely new and like rich environment. And things like GAIL, I mean, not to be kind of cheesy, but like the Global Alliance of Impact Lawyers convening things like this and thinking how the different groups of people and different professionals can work together in an environment where legislation is improving and increasing and strengthening. I think that's all stuff to be very positive about.
Well, thank you. And I didn't feed her that answer.
But she is going to buy me a drink.
On that note, we'll vacate and allow for some closing words from Ranajoy. And then for those who are here with us in the room, there'll be drinks.
I certainly don't want to keep people between drinks and closing remarks, so I'm going to be very quick. Look, there are a couple of really important themes that emerge from that. Thank you for the panelists for sharing their views as well. There are challenges, but this goes back to the point of GAIL and also the role of lawyers as well. Actually, I mean, we're living at a time where clearly the discussion is at the table. Clearly, there is a lot of impetus. There is a lot of momentum in the need to provide funding to tackle these problems around the world. And it's also clear, as you would have heard from Simon's thoughts, that public funding is not going to be enough. It's got to be a concerted effort between private and public sector. The takeaway from that is, yes, there's regulation. Yes, it's imperfect. It is evolving, but it is rapidly evolving as well. It is in a sector where there are challenges of greenwashing. There are challenges of funds. Sometimes these fund, from a design perspective, and we've heard a lot about fund managers, funds, and the natural tendency is to think of it in one type of fund. Is it a private equity kind of fund? Is it a vehicle? Some of these things are called funds, but they actually look more like aggregation of capital between the private and public sector, which can be a really powerful thing when the challenges are overcome and when you're designing as a group of lawyers, putting your mind together, we're working with clients to get that balance right through regulation, through tax, through the right vehicle, through the right measurements, data, because again, you're looking at different challenges across different jurisdictions as well. And it's a hugely rewarding process, I should add as well, to be working in that sector. And clearly, some things are happening right, otherwise all of you wouldn't be here as well. So a massive thank you again to our board for arranging and bringing all of this together, to CDC, of course, for hosting us in person, and a big thank you to you for everyone who's taken the trouble to join online, and everyone who's here in person as well. I do hope you join GAILnet and also keep the debate going, because these are really, really topical and really important discussions. So I hope this is the first of many conversations to come, and we certainly look to keep in touch. And thanks again to CDC. I think we've got, for those here, we've got some drinks on the 6th floor, I think. Yeah. Thank you again, and thanks very much for